Hey guys, JJ here. Welcome to our Lender's Lens 5-minute real estate Q&A brought to you by Always Capital. We're here to fund your deals. If you have a deal that needs funding, have any questions, or would like to join our next live event, please post your questions and see the detailed links in the comment section below. Today's question for Mark and Brian is, what's the difference between hard money and private money? Guys?
Hi, I'm Mark.
Hey guys, I'm Brian.
The difference between private and hard money, and this is a question we get asked a lot, is really what everybody thinks of private is what we call relationship money. This is the people who know, like, and trust you and are willing to stroke a check to you based on that relationship. They don't really care about the deal. They may not know anything about real estate, but they know you. The next level up is kind of what everybody thinks of as hard money, and this is institutional private. These are the companies and the people lending professionally, similar to Always Capital, who are looking at the deal itself. They may not know the borrower, and they're looking at the deal. And this is what's known as low doc loans, where it's about the LLC, and having enough assets to do the deal. Then there's actually a next level up, which is institutional banking money. These are full doc loans. These are your banks and credit unions who are doing full doc underwriting. They're looking at you as a borrower being able to sustain the deal without caring so much about the asset. So they're the cheapest, but they're the hardest money. Brian?
Yeah, so when people get educated in how to be a real estate investor and how to scale their business, most of the time the discussion comes that you would use that relationship money to do all of it. We would simply have essentially a friend write a check to fund your entire rehab or to pay for your entire rental property. In reality, that's not how it works so much. For one, most of your friends and family are an extremely finite resource and they have an extremely finite amount of capital. So it's very difficult for them to fund enough deals to sustain your entire business. And that's assuming you even know those people. So the way it scales far better is you use each of the three types that Mark was just talking about uh, in moderation, in the right place. So we will use a institutional private lender, like Always Capital, to fund our initial deal. And they're going to give you most of what you need, but not necessarily all of it. Let's say somewhere between 70 and 80% of the capital you need for a given transaction. And then you're going to use that relationship private capital to make up that gap, assuming you don't have your own capital to do that. And then after you've finished your project, finished the rehab, finished putting in tenants, stabilizing it, and you want to hold it, that's when you move on to that bank money, which is the most difficult to get, but it's by far the cheapest. So lowest cost of money, so we make the most over long term. So each of those three categories of capital is critical to scaling your business long term. They all have a purpose. You're going to need each and every one of them.
So that's basically the difference between hard money and private money.
Yes, it is, JJ.
Yep, exactly.
There you go. Well, guys, thank you for watching our Lender's Lens 5-minute real estate Q&A brought to you by Always Capital. We're here to fund your deals. If you have a deal that needs funding, please use the link in the comment section. We'd love to see you at our next live event. As always, if you have any questions, please submit them in the comment section below. We'll see you at the next one. Don't forget to like, share, and subscribe.